When it comes to retirement planning, annuities can tend to spark some pretty lively debate. Some feel that they are the best thing that you could possibly own in any portfolio, while others will tell you to avoid them like the plague. The purpose of the video today is to really cut through the fluff and explain the benefits of how annuities work, some of the drawbacks that they experience, and most importantly, who annuities can be right for. If we've not yet met, my name is Danny Cieniewicz. I'm a CFP professional from Hyperion Financial. So, what exactly is an annuity? An annuity, in and of itself, is a contract between the annuitant or the owner and the insurance company. And the owner slash annuitant essentially gives away a lump sum of money in exchange for a guaranteed income payout stream, typically for the rest of the individual's life. One of the best ways to describe it is to think about buying your own private pension plan. The payments can be made over a series of payments or they can be made in one lump sum. Regardless of how it works, annuities and insurance companies can offer a guarantee that they will pay out for the rest of the annuitant's life and potentially a joint life if that annuitant is married. In most cases, what an annuity will do is it will take away the risk and reward of stock market returns and in exchange guarantee the annuitant a guaranteed income stream for the rest of his or her life. One of the simplest ways that I can describe it is that you're transferring risk from you as the owner to the insurance company. Now, there are still some risks that can come up when you purchase an annuity. So while you may be transferring away some risks, not all risks will necessarily go away. Something that can be both a good thing and a bad thing is that there are so many different types of annuities. The good part of that is that one annuity may solve one or two issues that an annuitant may have, but the problem could be that there are so many annuities that it can also overwhelm the average consumer. So as a result, we want to cut through some of the different types of annuities that are out there. For example, there are immediate annuities, which would pay out right away. Deferred annuities will pay out at some point in the future. There are fixed annuities, which provide guaranteed interest rates and payments. There are variable annuities, which can be tied to the stock market, but can be more expensive and carry a little bit more risk. There are also equity indexed annuities. And what these can do is that they can offer some type of market-based returns, most of the times with a cap, but they will also offer downside protection as well. So each of these different types of annuities will have distinct features to it, and they'll have their trade-offs, their pros and their cons, but trying to find the right fit is the most important thing. So that does become the question, who is the right fit for an annuity? The biggest strength that annuities can carry, which nearly no other type of product can offer, is certainty. And certainty is something that many retirees may be craving. As a result, you're able to take advantage of the guarantees that the insurance company is able to put in place. By trading away the lump sum of money or by, again, making a series of payments over time to the insurance company, they can offer you a guaranteed payout income stream for the rest of your life. And this can be appealing to many retirees because defined benefit pensions are slowly becoming a thing of the past. Annuities can also provide peace of mind, especially if you know you're going to be short on a fixed expense in retirement. For example, if Social Security covers $2,500 a month, but you know you have expenses of $4,000 a month, you're not quite sure where that extra $1,500 a month will be, and you know these are fixed expenses, so you're going to have to pay them in retirement. Annuities can provide a sense of relief to know that that $1,500 a month will be guaranteed by the insurance company. And the other benefit of annuities, at least in most cases, is that they can provide for simplified management. Being that annuities can provide this guaranteed income stream, annuities in their simplest form can be relatively easy to understand. You know that you'll be getting a guaranteed income stream for the rest of your life, so the level of management isn't maybe what it would be if you had a more traditional type of approach. Now, annuities also have their downsides as well. One of the bigger ones that many consumers will face is the cost of annuities. Variable annuities can cost anywhere from 3 to 4% in any given year, depending on the different types of riders or the sub-account costs that could be associated with them. You could also be seeing opportunity costs that come about, specifically the amount of dollars that you're looking to quote unquote trade away to the insurance company you're no longer able to utilize, and it could affect your liquidity. If you put away too much of the dollars into an annuity, it could really hinder your liquidity. As a result, if a larger expense comes up or you have a maybe larger expense planned, it may not be the best idea to consider utilizing those dollars inside of an annuity. Many annuities also don't provide for inflation. Now, there could be very few types of annuities which could provide some inflation protection, but most are just going to cover fixed expenses. Over a 20, 25, or 30-year retirement, it should be considered that inflation can be one of the largest killers of a retirement portfolio. Making sure that you have this into account is probably one of the better strategies that you can consider. You also want to make sure that your legacy plan is accounted for as well. There are certain types of annuities which do provide joint life coverage. So it could cover for yourself and your spouse. If that's something that you want to do, you want to make sure that you complete the application as necessary. However, when it comes to the children, there may not necessarily be death benefit protections in place. Now, there are some potential opportunities in given contracts that could allow for that, but making sure that you understand this before you sign the dotted line is probably in your best interest. And one of the other downsides that many annuities carry are the marketing issues that are out there. You should be aware of the types of benefits and the drawbacks that an annuity can carry. You should also be aware of how the quote unquote salesperson or advisor is going to get compensated if they're going to recommend this annuity to you. Many different types of annuity plans can make sense in the right situation for the consumer, but sometimes they can be pushed a little bit more than maybe they should be. As a result, you should have your plan and the annuity and the practical application of it analyzed and evaluated in an unbiased way. So, who should actually be considering annuities? Who are some of the folks that are better utilized to take advantage of annuities? Well, for starters, there's a couple things that I think you should be making sure that you have before you go ahead and sign up for one. The first one would be a lack of guaranteed income to cover necessary and fixed expenses. If you feel like you are not in a place where you will have this covered by Social Security or a pension, but you will have necessary fixed expenses, you could have your mind put at ease if you knew that an annuity would provide for some level of fixed income and cover the fixed expense that you could be facing. Other ones include ones that are very conservative by nature and just looking for a guaranteed income stream of money. If you're terrified of market returns and you would plan to be in 100% cash if that was the alternative, perhaps it could be worth considering an annuity. If you also have longevity concerns or worry about outliving your money, it may make sense to consider some type of an annuity within your plan. But again, make sure that there's also an inflation adjustment to this annuity, or understand if there is no inflation adjustment, that the dollars today may not spend like they will years into the future. Annuities may not make sense for consumers who instead do feel like they have guaranteed income that will cover their base expenses. In other words, they feel like they have a pension and Social Security, which provides for a strong base and is covering fixed expenses. Maybe the additional expenses that they're looking to have covered are more discretionary in nature. Annuities may not make sense for those types of consumers because they may value liquidity and in potential investment returns over time rather than taking advantage of the guarantees that an annuity can offer. Those who have also constructed some type of income plan from an investment portfolio, they may also be ones that may not need an annuity. Now, guaranteed income returns are not necessarily a feature with market-based returns, where they can be with certain types of annuity products. So making sure you understand which types of plans are guaranteed and which are not by an insurance company is also in your best interest. Lastly, for consumers who value flexibility, decreased costs, and potential to continue to see their accounts grow in retirement with investment returns over time, they may be ones who may not necessarily need an annuity and therefore should not be considering an annuity. With all of this, I think it's important to make sure that you understand that this is part of a larger strategy. Annuities are not inherently good nor bad. They are simply a product. They can provide a solution to a potential problem, or they can make a potential problem worse, depending on the practical application. You may meet some consumers out there who swear by their annuities and say that they're the greatest things ever. Others may say that they're terrible and you should avoid at all costs. Now, your practical application may dictate one of those answers. However, you shouldn't just go in with any type of preconceived notions. Instead, you should go in with an open mind and see if it makes sense for your situation. I think it's also important to make sure that you get unbiased advice from any source, whether that be somebody who's pitching a market-based return or somebody who's pitching an annuity. The decision should be made right for you. It doesn't necessarily mean that any salesperson shouldn't be compensated. It just means that if there are going to be compensated, they should be compensated fairly, and they should be doing so for solving a problem that you may be facing. Therefore, getting the unbiased advice that you may be seeking, it could very well make sense in your situation. You don't know that until you've actually strategized and planned ahead to understand if an annuity or any type of product is right for you. Purchasing an annuity is a personal decision. It should not be something that should be dictated by some talking head, myself included, and it should not be dictated by any type of salesperson. You should be seeking out a salesperson if you feel like an annuity is right for you. And again, perhaps it is, maybe it's not. You don't know that until you actually have gone through and really figured out what your situation is best calling. My team and I at Hyperion Financial help retirees focus on exactly that. And if you're interested in learning more, check out HyperionFP.com. Now, annuities are not the only way in which you can draw income in retirement. Many retirees instead want to do so from retirement assets they have saved. But one thing that you want to make sure of is that you avoid sequence of returns risk. In order to avoid that, it might be worth checking out this video right here.